Hey everyone, welcome back to another training. Today we're going to be talking about the cash flow statement. If you guys remember in the last video, we were talking about the balance sheet. Now we're on to the final part of the three statements, the cash flow statement. So the cash flow statement, let's just jump right in, divided into three sections. We've got cash flow from operations, cash flow from investing, and cash flow from financing. Roughly speaking, cash flow from operations is cash that's involved with the business operating day to day. So you have your net income. Remember, this is your profits. And you also have a bunch of other stuff that's directly involved with the business, the business's operations. Next, we have cash flow from investing. This is cash flow that's making for internal investments. So this is things that will be important in the future, but aren't essential to the business operating right now. And finally, we have cash flow from financing, which is cash flow from making financing decisions, things like issuing debt, equity, paying off debt, things like that, all go in this bucket. And then we have our net change in cash, which is just adding up all the changes in cash from the different sections. So let's jump into the cash flow from operations section. There are two ways to calculate cash flow from operations. One way is the direct method. So this is where you keep track of everything that's coming into your business cash-wise and everything that's going out. And you just keep really good details, and then that tells you what your cash flow is because you know what's coming in and out. This is called the indirect method. And the indirect method, what it does is it starts with net income, and it says, and it adjusts net income for all the things that affected your net income, but did not affect your cash flow. So what I mean by that is for example, here's one: depreciation and amortization. This is a non-cash expense. What that means is that you can imagine if you have a factory that's worth $100 in 1 year, and then the next year it depreciates, and now it's only worth $80. You just lost $20 from depreciation. You incurred a depreciation expense of $20. And depreciation reduces your net income. If you remember from this video, when we were calculating EBITDA, depreciation and amortization is hidden here in these line items in this general area. So that decreases your net income. But does it decrease your cash? If your factory decreases in value, did you lose any cash from that? No. So it's a non-cash expense. What we do is we add it back. So you can see in this formula here, we're summing these cells here and this cell here, this change in net working capital. We're summing all those cells because we're adding back the non-cash expenses that decreased our net income to try to indirectly find out what our cash flow from operations was. Here's another one here: stock-based compensation. So this is when you pay an employee, but you don't pay them with cash. You don't send them a check in the mail. You pay them with stock. And so that you can imagine that would not reduce your cash balance because you're issuing new shares to pay your employees. So it's an expense that reduces your net income, but because it doesn't reduce your cash, we add it back. And you can see that this company doesn't pay any stock-based compensation, but you can imagine that there are lots of companies that do, especially technology companies. Okay, so those are our non-cash expenses. Now we get down to our net working capital. And this, if you guys remember anything from this video, I want this to be the thing that you remember, because this is one of the hardest things to understand the intuition behind. So the idea behind net working capital is that we're trying to get a handle on cash that was used to pay for stuff by looking at the changes in the value of assets and liabilities. And what I mean by that is, imagine this. In 1 year, you have $10 of inventory, and in the next year, you had $20 of inventory. So even though I haven't told you anything about the business, in order to get from 10 to 20, you would have had to have spent $10 on inventory. And so that would have decreased your cash balance by $10. And so what we do is we say inventory, because we call it a use of cash. It requires cash to increase. In order to increase inventory, you need to spend cash. We call that a use of cash. When inventory increases, we take the negative of that increase, and that's the change in inventory cash that's required to change that inventory. So I'll show you the formula. Right here, we're looking at inventory in 2020, subtracting it from inventory in 2019. So it went up by $3. So this right here is $3, multiplying it by -1. We're just saying, because it went up by $3, cash has to have gone down by $3 in those years. Okay, and we can see that this is a -3. Accounts receivable is the same thing. It's also a use of cash. In order for accounts receivable to increase, you have to have used up cash at some point. And then we get into these like current liabilities, and these are sources of cash. And so when these increase, we actually get cash when these increase. And so this formula, instead of multiplying by -1, it simply takes the difference between this year and this year. When accounts payable increases by 1, you get $1 of cash, and that's just how the net working capital calculation works. And so this total change in net working capital is just the sum of all of the current assets and current liabilities. And a side note, working capital kind of it means a similar thing to current assets and current liabilities. These are the assets and liabilities that are important for the operation, the day-to-day operations of the business. And so we subtract that net working capital, and what we're doing here is we're saying that all in all, these working capital items, the sources increased enough, and the uses increased enough, which decreased our cash enough to reduce our total cash across all of them by $1 in this year, $3 in this year, and $2 in this year. And so in our formula here, we simply subtract that net working capital change from our cash flow from operations total. So that's a little tough. If you guys need to go back and watch that again, or look it up on Google or YouTube, or ask ChatGPT or whatever to explain it to you, go ahead. This is a hard topic to understand, but it's really important for understanding how companies generate cash flow. Next, cash flow from investing. There's only one line item here. Pretty commonly, there aren't going to be a lot of line items here. Other line items you could see is like maybe spending to acquire another company that might show up here. But capital expenditures is when you buy factories, or you buy land, or you buy property, or whatever. It's when you're making capital investments in your business to support future production, future growth. And as you can imagine, if you buy 30 million worth of factories, it reduces your cash flow by 30 million. And so these numbers are just the same because there's just one line item there. Financing activities. This is decisions that are separate from the operations of your business and separate from the investing activities of your business too. These are financing activities. So this is taking out debt, issuing stock, buying back stock, anything like that. You can imagine that would affect your cash balance. If you issue debt, it's going to increase your cash balance. If you pay off your debt, it's going to decrease your cash balance. And you can see that here. You can see that in this year, we have 20 million in proceeds from debt financing. Can we see that on the balance sheet? Balance sheet right here. Yeah, we can see our short-term loans went from 0 to 20. So we issued debt in between these periods. And so we can see that our proceeds from debt financing increased our cash by $20. What about this one here? Repayment of debt decreased by 20. Well, if you remember from the balance sheet video, we had this long-term debt that became current. 20 million of this 100 million became current in this year, and we had to pay it. And so you can see that decreased our cash balance by $20 million. And you can see this company, they didn't issue any stock, and nor did they do any dividends or buybacks. But you can imagine that if you issue stock, you get cash. If you buy back stock, your cash decreases. And if you pay dividends, your cash also decreases. So we sum that up. That's cash flow from financing. And then for the entire cash flow statement, we just add up all three. We add up operations, investing, and financing to get our total net change in cash. So if you're an investor, what do you care about here? What are you looking at? Well, you're looking at the free cash flow of the business. These things are totally up to the company, and it in some ways it doesn't matter what they do. Obviously, you don't want them to do stupid things, but most companies are pretty good at making financing decisions. So what you're looking at is the free cash flow, which is the cash flow that's separate from financing decisions. So the formula here is you're taking this cash flow from operations, subtracting capital expenditures, so in investments for future business, and you're also, because this is levered free cash flow, you're subtracting interest expense here. So this is the free cash flow after the debt holders have been paid, that we paid them their interest. This is the cash flow that's left over for equity holders, people who own stock in this company. We can see that's been increasing. Unlevered free cash flow. This is cash flow that's available not just to equity holders, but to every holder of capital in the business. So what this is the same thing. We just take cash flow from operations minus CapEx. And we just don't subtract our interest expense because, this is capital that's available to everyone, not just after the debt holders have taken their piece. There are a couple of different ways to calculate free cash flow. This is probably not one of the greatest ones. I would prefer to do, NOPAT times 1 minus the tax rate, minus CapEx, minus change in net working capital, whatever. There's a whole formula. You can look it up. I think that one's more reliable, but this one has this free cash flow calculation is just this cash flow from operations minus CapEx, whatever. We can also calculate the margin on that. So we're just taking the free cash flow, unlevered free cash flow, and dividing it by revenue to get an idea of how efficient are we at turning revenue into free cash flow in the business. And you can see this has been increasing over the years, which is great. That's a really good thing to see in a business if there's a positive margin trend. So I'm going to end the video here, but stay tuned for more videos in the future.